People argue that you cannot tax billionaires on the shares that they hold in a company because it is an unrealized gain. So they go like, yeah, you're worth 300 billion, but we can't tax you on those stocks because you haven't sold the shares. So you don't like have the money, right? But you're worth the money, but you don't have the money. And I understand the argument. They go like, no, you don't have it. It's just what it's worth because it will also crash. And then you have nothing, so we can't tax you on it. Then I'm like, okay, I understand that. So you can't tax the people on a thing because they don't have it. It's just there. Then Elon Musk offers to buy Twitter. He now goes to private equity and banks and like other rich people and whatever. He goes like, can you guys borrow me the money to buy Twitter because I don't want to sell any of my Tesla shares. But then they're like, what are we loaning it against? And he's like, well, my Tesla shares.
So any business owner, not just billionaires, wouldn't want to be taxed on an asset that you haven't yet sold because you don't have the cash yet to pay the tax from selling that asset. And I'm sure there would be a way to tax unrealized gains for people who are above a certain income threshold where they just own a public company and they can sell the shares to cover. But here's why US tax policy doesn't tax unrealized gains. And it goes back to our definition of income from a 1955 court case, Glenshaw Glass, which is an undeniable accession of wealth, clearly realized over which you have control. Okay, and without the sale of the business, the realization event has not happened, and loans against assets are not taxable because they are not an undeniable accession of wealth because it needs to be paid back. And for actual tax law from a tax attorney, subscribe.